where we put you on the map. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas, Nevada. And folks, we're going to pretty much be winding down the year a little bit. Boy, this year went fast. It wasn't really that great for a lot of people. 2020 was crazy. But we did a podcast the other day about cost segregation. We're going to bring that back. We're going to bring that topic back, a little bit of opportunity zones. And in order to do that, let's introduce Vicki Hutchmala from the QOZ Marketplace and the Opportunity Zones Authority. Vicki, what's going on today?
Hi, Ron. Great day. Good day in Vegas. I was a little worried when I got up this morning. The skies were all cloudy, no sun in sight. But now, like normal, blue skies, no clouds. Great day in Vegas. Excellent guest today on our podcast, as always. So let's get started.
Yeah, our last podcast with the cost segregation brought up a lot of questions, and a lot of people contacted us, and we're going to kind of get into that a little bit today. So let's introduce Clint Edgington. Clint is the founder of the Nest Opportunity Fund. He's been on the show before. Clint, how are you doing today?
Great, Vicki. Great, Ron. Thanks for having me. Excited to be here.
Yeah, thanks for coming on again. We appreciate the time. So, boy, I know, like I said at the start, 2020 was a crazy year, but it's already December already, and some people think that the year went fast, right? We're closing down on some deadlines, huh?
It was kind of the longest, slowest year all at the same time at different times, right?
And we all went a little crazy, but now we're kind of getting back on track.
That's right.
Yes.
Yeah, and there are some deadlines coming up for folks. The CARES Act that was put in place because of this crazy year can help folks with the bonus depreciation and depreciation they haven't taken for the last 3 years. And that's one thing that came out of this crazy year that can be good. So those out there that didn't get around to it or think about it in 2018 or 19, they can do it now, and they can take back those past year of depreciation, which I think is probably beneficial and a good segue from your last podcast to this one.
Yeah, exactly. And before we get further into this, so why don't you give us a little bit of overview on the Nest Opportunity Fund and what it is and how you guys are doing with that so far?
Sure. Yeah. So it kind of stems from our work at our registered investment advisory firm, Beacon Hill. We do planning for business owners, and in 2017, I kind of had my first decent-sized capital gains for me at least, and as did my family and a real estate operator that we had been funding for about 10 years. And at the same time we all had those cap gains, we went ahead and created our own little partnership. We called it a fund, but it was really just a checkbook and a bank account. Started it up, and then so we were certified in April of 2019, and then we opened it up once the legislation was finalized. And we've got all institutionalized and dealing with our auditors and legal counsel for a while, and last December we opened up to outside investors, including our Beacon Hill clients. And so we raised about $4 million last December, and have been working hard on residential properties in the Midwest. Namely, we deal with Columbus, Ohio, and Lexington, Kentucky, which are good growth markets in the Midwest, and we've been doing pretty well. So we've probably got about 35 properties, of which we've got 10 projects completed, and we've been getting appraisals at about 19% over our costs. So even though this year has been interesting to kind of refine our operations, and material costs have been all over the board, lumber more than doubled this year. It seems like we're still doing things that are economically valuable for ourselves and helping the community.
So are the projects that the Nest Fund is working on, how many actual projects are you working, are in progress, and are they centrally located, or how do you decide where to put a project in what opportunity zone around the country?
Yeah. So the first thing we look for is, I believe real estate's a ground game. You've got to be there. It's kind of a knife fight from time to time. So the first kind of scrub, the first criteria is that I can go review assets and be home in time for dinner, which I do at least once a month for all of our assets. And then the second is we want areas that the demographics are tailwinds and not headwinds. And so, in the Midwest, that means you don't really go to Cleveland or Detroit. You kind of stay below the Rust Belt.
Right.
That would be Columbus, Indianapolis, Louisville, and Lexington are the good demographic areas like that. And then finally, it's where you have good operators, because a great operator in a bad location will do okay, but a bad operator in the best location will not do well. So for us, we've got good experience and a presence in Columbus and good experience in Lexington. And those are our two markets. We may expand someday, but for now, there's plenty of opportunities where we're at there.
And are you finding it easy or difficult to get investors to invest in your Opportunity Zone fund, or how do you go about getting the money into your fund?
Yeah, boy, that's a good question. So last year, it was relatively easy for us. So our registered investment advisory firm caters to business owners, and about 3 or 4 per year will sell their businesses. And they'll have large cap gains, and they'll have liquid assets that previously weren't liquid. So they were kind of natural investors in our fund, and they already know, like, and trust us, so that makes it a bit easier. And then also our clients have portfolio realized gains. And so, for 3 weeks towards the end of 2019, we did a pretty good raise pretty quickly, and that was helpful. And then, this year it's been a little bit different, so it's been quiet. I'm not sure if it's because, when there's so much uncertainty, investors freeze, which certainly happens. The business sale market really was frozen from February until September. So the 3 or 4 businesses we usually have sell a year were all postponed. And then, like a lot of investors and investment advisory firms out there, we tax loss harvested in February and March, so we were able to kind of have paper write-offs for our clients for cap gains this year. So it's been much more quiet this year, although all of the deadlines have been kicked until December 31 of this year. And the good thing about a deadline is it makes people invest. But the bad thing is they'll wait to invest. So the jury is still open on how it will do this year, and I will certainly let you all know.
So talk to us about the deadlines that are coming up December 31st regarding Opportunity Zone, so that people know what they need to do and need to do it quickly.
Yeah, for any investor who personally had an asset, it was titled to them personally, maybe an individual brokerage account, and if they had a capital gain that was realized on or after October 4th of 2019 up until about June of this year, their deadline will be December 31 of this year. And then if they sold it sometime after June, it will be 180 days after their sell, whenever that is. For those that held an asset within an entity, past their entity, that gain would have dropped down to them as of January 1st of this year, and if they sold that asset anytime in 2019. And so they could then invest personally through December 31 of 2020. If the asset was held in an entity and sold prior to June of this year, that entity would have until the end of the year, or it will drop down to their personal returns as of January 1st. And then they'll have 180 days either after that January 1st date or after the tax filing deadline for their entity without extensions.
Oh, very nice. So we know that we did a previous podcast with Yona Weiss, and he talked about cost segregation and Opportunity Zone. So would you like to expand on that?
Yeah, it brought up the point in my mind that I've been discussing with some folks, that we all know the basic benefits of an Opportunity Zone investment. You can defer your original cap gain. It gets reduced by 10%, and then you have a tax-free exit of the Opportunity Zone fund if you hold for over 10 years. But what's interesting, within our RIA, we do financial planning that can be a little bit more complicated at times, and there's just a lot of facets to this law that can be to folks' benefits in more niche areas. So, for example, with the depreciation that occurs, the mechanics of how that tax-free exit of the Opportunity Zone fund are written, it doesn't just say you receive your capital gains tax-free. It actually says you receive a step up in your basis up to the fair market value at the time of sale, as long as that sale occurs before 2047. So we don't exactly know how that marking to market would be in 2047, but that's a long time off. But in particular, for those that will sell in 10 or 12 years, it means that by stepping up the basis to the fair market value, there also will be no depreciation recapture. And Yona kind of mentioned that on the podcast that, hey, listen, you could take this depreciation right off through time. However, you do have to pay a recapture tax that's at 25 to 28% when you do sell. But with the Opportunity Zone funds, as long as you hold for that 10 years, you also don't get that depreciation recapture, which can be pretty compelling.
Right.
So just if there's no accelerated depreciation, on regular depreciable property that has a 27.5-year life, you get to write off 3.6% of the basis per year. So if you just held it 10 years of straight line, basically you get 36% of your basis back as depreciation, as a write-off. And then usually we have to then get taxed on that when we sell, and this time you get it for free, which can kind of mean real money. And then if you accelerate the depreciation, which I really think all Opportunity Zone funds should highly consider, for those investors that want out after 10 years, otherwise they're just going to get basically a third of the depreciation coming to them. Whereas if you accelerate, you can get, a large chunk of it to them within their 10-year time frame, and they don't pay taxes on it. So, with no cost, with that cost segregation, they're probably going to get 40 to 50% of the depreciable tax basis back. So if someone puts $150,000 in just the simplest forms and $100,000 of that depreciable property, 40 to 50% is going to come back as depreciation, which is going to be worth, 16 to 20 grand to them. So it's like a 10 to 13% return, just based on just holding an asset, whether it appreciates or not.
Yeah.
And then,
go on.
If someone would just leverage it at 50% loan to value and buy two of those properties, now you're getting like a 20-25% return just for holding a property, even if it doesn't appreciate.
So in general, are Opportunity Zone fund managers aware of this strategy? Do they utilize this correctly, do you think?
I've seen that some of the large asset players who are into large assets in the first place and already know that area, I do see them doing it, but I don't see many of the small asset players doing it.
Because they simply aren't aware of it, or they don't do that much with Opportunity Zones? What do you think?
I'm not exactly sure. I think likely for the same reason that it didn't initially dawn on me. And then when I talked to our CPAs and attorneys, we all kind of got the aha moment at the same time. And I think that reason is simply because if you're used to dealing with smaller assets, if you're used to owning a $300,000 property, well, historically a $5,000 or $8,000 cost segregation analysis by an engineer just didn't really make any sense because, you were getting the write-off early, but you still paid the tax on it later. So is the time value of money enough to offset that frictional cost? At some point it is, and at some point it isn't, depending on the size of the asset. But now when the write-off is going to be free in the end, well, that changes the equation an awful lot. And there are a lot of ways of doing it that are more efficient than historically what we've thought of. So that's my guess on it.
That sounds right. Yeah, I would agree with you on that. We're talking
because
basically
frankly,
real estate.
Out the gates, when we did it, I wasn't, when we created even our PPM projections last year, my projections don't show accelerated depreciation because it just didn't dawn on me yet. It didn't dawn on me until about spring of this year. And I haven't heard many other people who are shouting that from the rooftops quite like I'm trying to do.
Yeah, see, that's when COVID hit actually. So you were quarantined and you were able to come up with these brilliant insights there by yourself, right?
maybe when I was quarantined, it was like a beautiful mind in my home office.
See that? Yeah.
So does that mean we should, like, every year go through a month lockdown and stay home so we can get these brilliant ideas?
No money is worth it.
Yeah, be careful what you say.
Agree.
Vicki, be careful what you say. You don't know how many governors are listening to this podcast right now.
Oh, I take it back.
But anyway, yeah, Clint, listen, we're talking about the depreciation with respect to real estate. Does this have anything to do with, like, businesses that are in opportunity zones? Do they get any benefits out of this at all?
Yeah, certainly. I mean, you can depreciate all sorts of business property down. You can depreciation intellectual property down, all sorts of things. Just like you could regularly with any business. The only benefit is that you don't have to pay the recapture back when you go to sell. The only other quirk that is specific to opportunity zones with the depreciation idea is that for those who are contributing qualified capital gains, which I think the majority of investors will be, so they can get those OZ benefits, you don't naturally have basis. You're taking money that has not yet been taxed, investing in an opportunity zone fund. You don't have basis, and our passive loss rules basically say, hey, listen, if you don't have anything in there at risk, you can't take a loss. And so in that case, the opportunity zone fund, whether it's a partnership with a few people or a large fund, has to figure out a way to effectively get those limited partners, quote unquote, at risk basis. And there are ways to do it. But I would just say to folks, if you ask your OZ fund about that, hey, do I have basis to get this depreciation? And if you're met with blank stares, you don't. So the way we've done it is that, we were able to work with one of our government investors. They gave us some grant money in the form of a forgivable loan, and that was structured to be recourse only to the fund. Had I signed on it personally, like, initially they wanted us to do until I talked to them for a while. Unfortunately, the head was a CPA, and so he understood it when I started talking to him about it. But if I would have signed personally on it, like I would usually do any other bank loan, then that would have been recourse to me, but not to my other LPs. So I would have gotten that risk basis. My other LPs would not have. So it can be recourse to the fund, it can be recourse to the project, but as soon as it's recourse to a person, then nobody else gets that at-risk benefit.
So it depends on the quality of advisors that you have around you, the benefit that you're going to recognize or realize, rather.
Well, yeah, or, the quality of the OZ offering. But yeah.
True.
Yeah.
True. So in light of that, what do you advise your clients and investors what they need to be doing now before the end of the year to help them for 2021? Are there any specific things that you're advising them now to be able to take advantage of for next year?
There are no catch-alls, unfortunately, or, well, I guess maybe fortunately, or else I would be replaced by a calculator or a Google program. But otherwise high-priced helpers get paid less. And I would say, for those who are looking, to potentially make 400 and above, likely the Senate is not going to flip. However, the midterms, it may. In 2022, and I would err towards caution with the tax brackets for those making over $400,000, and I would start to think about ways to deal with that now. So, for example, if you make, in particular, those making $400,000, if the Biden proposals would go through, which again I don't think they will now, I doubt they will in 2022. But if you plan for it now, you won't be harmed, but you might be helped. So it's kind of a heads you win, tails you don't lose. You might think about taking income now that you wouldn't be, and you might think about structuring retirement portfolios in ways that would reduce future income at the expense of taking income today. So, for example, Roth conversions or just simply contributing to Roth, pretty simple things like that. But for those making $400,000, if the Biden administration proposals would go through, it's a pretty hefty tax increase, and much more than we think. I think I initially just thought, okay, the 37% bracket is going to move to 39.6. All right, fine. But in fact, when we look at it, because it dips down in income, not by bracket, those making over 400 are currently in a 32% bracket. So there's a step up from 32 to 39.6, and that's a pretty big step.
Yeah, that's significant.
And then they're going to be levied with an additional payroll tax of about 13%. So boom, now all of a sudden we're up to about 60%. I'm sorry, about 50%. And then if they are in owners of pass-through entities that are getting the Section 199A, they don't get that 20%, deduction off the top of their business income. So really relatively quickly at the federal level, they can move from 32% to darn near close to 60. So that would make some sense for those folks to be thinking about and talking to their CPAs, as long as their CPAs are proactive. If not, find a proactive CPA.
Yeah, that's the key. Yeah, you got to be proactive on something like that.
Yeah.
I would
also say, again, I don't think this occurring, although I think the likelihood is higher than, the Biden tax proposals moving up. But we do have a sunsetting of the gift and estate tax exemption. Currently, since 2015, it was basically set so that each spouse had, it was previously $5 million apiece to give, and then it moved up to $11.6 million, and $11.6 million for a couple, which makes it $23 million-ish. That's a good estate. But when we move it back down, it's adjusted for inflation. We move that back down to about $13 million. That's just to catch a lot of high net worth folks, but not folks you think of as really rich. And so folks who have a portfolio of around $10 million for a couple, they should start thinking about using that additional gift and estate tax exemption. And you could gift up to, you gift your whole $10 million away today, and there's not going to be a clawback with it. And with the, kind of bringing back in the OZs, you could gift interest to a grantor trust, your qualified opportunity zone interests, and the amount that you gift is an exemption, and that counts against your lifetime exemption. But
Right.
Then the growth in it doesn't. And unlike most assets, the growth in most assets, once you put it in a grantor trust, it goes to the heir at the original basis. So if you would gift it at $1 million and it goes to the heir at $2 million and they sell, they have $1 million cap gain to pay. But the beautiful thing is you can kind of twin the OZ with the grantor trust, and you can gift it for $1 million, and that $1 million counts against your estate, against your gift exemption. But when it grows to $2 million and the heir sells, you have the QOF step up to fair market value that offsets that. So that, I think, is some interesting things. I don't think that's a deadline of December 31. It would be, I think, very rare for, even if the Senate did flip, Congress made the change for them to make that retroactive or make that for 2021 and not 2022. But, crazier things have happened, certainly.
Well, and if you have an opportunity zone, a fund or project or something in your trust, a grantor trust, wouldn't you want to keep it in there for as long as you can, just so the trust doesn't incur the capital gain tax?
Yeah, but after the death of the original grantor, the heirs will do what the heirs will do, depending on how you have it written out. But yeah, you would want to let it ride, certainly. And I guess the last thing that would be somewhat timely out there would be for business owners who are selling, if they've got an asset deal, if it's not a stock purchase, if it's an asset purchase, and in particular if they have a business with Section 1231 assets, which are real or depreciable assets used in a trade or business. There are ways to basically cherry pick the gains and losses that are 1231 that usually offset each other, and to invest the 1231 cap gains into an opportunity zone fund which then would leave you with that amount more of 1231 capital losses, which then are actually converted into income tax write-offs. So, if somebody had $500,000 in 1231 gains and $500,000 in 1231 losses, at the end of the year that would basically net out to zero if they did nothing. But they could instead take $500,000 of those gains, plop it into an OZ fund, and then have a tax write-off next year, or this year technically, of $500,000, which basically more than doubles the benefits of most opportunity zone investments I've seen.
Oh, okay.
So that can be pretty compelling too.
Right,
that would have to occur by December 31 of this year.
So
if the asset sale was finalized this year.
So basically, people have 2 weeks to take the most advantage of what you can do with your income this year and how you can plot out what you are going to be able to do with your income as it develops next year. But the bottom line is, if you don't have a financial planner or a CPA who's aware of these various procedures, you kind of are out of luck. Or if you don't have financial planners that are proactive to their clients and helping them ahead of time to just let them be aware, nobody's going to know this kind of stuff if you're not on top of it. How many people are actually on top of, what their planners are doing for them? They just leave it up to them to make the decision. So this is important that you act now, right?
Yeah, I think if any of those categories hits your fact pattern, then it probably makes sense to talk to a proactive planner or CPA, one who spends their quarantine in their basement with
yeah.
place and not on the beach or doing something fun.
yeah. Well,
and if they were good, they would already be aware of it and helping you out,
right.
Not waiting till the last minute. But even if they aren't, and despite the size of your estate, people still should be calling and asking, what am I doing? What are you doing? And how can I take the best advantage before the end of this year and to help me into next year? At least ask the question whether or not it's to your advantage. At least know that there's something out there and ask the question and not lose out.
Yeah, that's right. I think you really, for a lot of these things, the potential benefits are kind of nebulous. So for me, I'm a spreadsheet guy. I got to put pen to paper and analyze the cost and benefits. And, I take it to the client and say, hey, is the juice worth the squeeze or not? And either way is fine. And I'll tell you, for any listeners out there, for the OZ space, if your listeners want to give us a call, hey, if they want to invest in our fund, that'd be fantastic. If they don't, that's fine too. We're happy to run. We have a little calculator set up on just what the cost versus benefits would be of going with an OZ fund or not. And you can customize the rates of return with the OZ investment versus, what you would invest in otherwise and your marginal tax rate in your state. And then just walk us through the fact pattern and we'll get it to you. And a lot of times we've seen maybe on about a third of them is we can kind of look at it and say, listen, maybe it'd be better if you'd structure it in an alternative way, in particular for business asset sales. If you've got an asset sale that you're working with for yourself or for a client, that's something that we can kind of do a lot of work with. The IRS has basically said purchase allocation is a negotiated item. They don't care how it is as long as you and the seller have it the same. So it gives us a wide amount of flexibility that we can use to really benefit our client on it.
Right. Yeah, my takeaway from this podcast is I got to find a couple of friends that can gift me a couple of $1 million in 2021. That would be a good thing to do. But in the meantime, Clint, how does somebody get a hold of you though if they want to get more information or they want more information on the Nest Opportunity Fund? What's the best way to contact you?
Yep, they can just go to our website for the Nest Opportunity Fund. It's nestopportunityfund.com. Our planning firm is beaconhilladvisory.com, or just call me 614-469-4685 is the office line, and they'll punch you through to me.
Yeah, and then I just have one more question before we close this out. Now, obviously, we're coming down to deadlines, et cetera. We just talked about this for a half hour. But what do you say to the person who just kind of figured out opportunity zones? You know, they heard about it. They were a little skeptical at first, and they did a little research, and now they said, you know what, I've got, I don't know, just pick a number, $100,000 in taxes that I need to defer. But they can't find a good deal that they like right now. Like maybe in January they do. Does that person, how much does that person really lose out on? Do they lose out on just 1 year of the benefits, or I mean, should they be concerned?
Is that client, when would their capital gain have been realized?
Well, let's say in this year, in this year.
Okay. Well, if there is time and they have 180 days, they can use that whole 180 days to figure out what's due. If it's a large number, I would say $100,000, the juice isn't worth the squeeze. But if it's a large number, they can create their own qualified opportunity zone fund, and then look for other qualified opportunity zone funds that have good subsidiaries and invest directly in those. I'd say $100,000, juice isn't worth the squeeze to do that. Just pay the taxes and move on. But if it's someone that has a deadline of December 31, well, no, they don't just lose a year. They lose the ability to put it into a quaff at all. And maybe they'll have more qualified capital gains in the future, but that particular one, that ship will have sailed.
Got it. Right. Okay.
And even if they don't have even if they don't have enough, 100,000 is really, I mean, not worth the hassle of creating an opportunity zone fund. That's not much money, but that doesn't mean that they can't invest it in an existing fund like the Nest Fund and still be able to take advantage of it.
Right.
Absolutely. And that's what they should do anyways.
Yeah, of course. Right.
Well, absolutely that's what they should do, Clint. I mean, that just goes without saying. Invest your money in the Nest Opportunity Zone Fund.
There you go. There you go. All right. Boy, I'll tell you, this is more interesting stuff. It should get people off their butts and the final steps they need to take before the end of the year. Vicki, any closing questions for Clint, or what do you think?
Well, you know, opportunity zones initially seemed like a simple thing that, you know, put your money in, invest it, and then don't pay taxes. But there's so many nuances to how they work and to the best advantage and the time frame and that they're a little more complicated than people seem to realize. And that's why you really need professionals like Clint who can help you to maneuver the nuances of opportunity zones and really take the best advantage. I always say it, Ron, you need the best advisors and the best professionals to help you with what you want to do so that you actually succeed at the end of it. And that's what Clint does. And that's why everyone out there needs to invest their money with Nest Opportunity Zone.
There we go.
Because Clint does such a great job.
I appreciate your time today.
Yes, thank you so much, Clint. Thanks for being a guest on the show. Vicki, thanks for co-hosting the show with me today. And folks out there, you're listening to the Mappable USA podcast at mappableiusa.com. If you go to that website and you scroll down on the homepage, you'll see all our syndication sources. Pick the one you like best, subscribe, and you'll never miss another episode. If you want to be a guest on the show like Clint was today, and by the way, this is Clint's second time, so we always look for repeat guests. Just fill out that form, and we'll see what we do about getting you on the show. And if you like what you heard today or need further information, send us an email, info@mappableiusa.com, or fill out the comments section on whatever page you're listening to this podcast on right now. So thanks for listening. Thanks for your support, and we'll be at you next week with another Mappable USA podcast. Have a great week, everyone.